As a GEPF member, are you feeling overwhelmed and uncertain about whether to retire or resign? Do you worry about all the things that you need to get done in order to make your resignation a success? Now, you're not alone. I know how tough this decision can be, and it's even harder when you can't find the information that you need on resigning. It's not in the textbooks, and I know this firsthand because I have a postgraduate diploma in financial planning, which I attained cum laude. I'm also a certified financial planner, which is a mark of international excellence. But this video is not about my qualifications. It's about you and the fact that you deserve the best guidance possible for one of the most important financial decisions of your life. Now, over the last 20 years, I've dedicated myself to researching the successes and failures of GEPF members like yourself. I've interviewed hundreds of members and learned from their experiences, uncovering the pain points and the challenges that they faced. Now, by the end of this video, you'll be armed with the knowledge that you need in order to avoid common mistakes and make an informed decision about your future. I'll reveal the hidden risks about resigning from GEPF and show you how to overcome them. I also have a secret I want to share with you. It's the only secret that you need in order to make your resignation a success. So stay tuned for that big reveal, which will happen towards the end of this video. Now, if you're ready to take control of your financial destiny and ensure you're making the best decision possible for you and your family, keep watching. Let's dive into the world of GEPF resignations and help you secure a brighter future. Now, I first want to start by just doing a quick comparison between retiring and resigning. It's going to be brief because I just want to explain to you one key aspect, right? And the key aspect here is around control. You see, if you are aiming at retiring, you basically are leaving that control within GEPF and the trustees. So in essence, what this means is they will determine for you what your gratuity is going to be. So they will calculate that figure, right? You don't have a choice in it. You cannot increase it. You cannot decrease it. It's predetermined for you. They'll also predetermine the income for you. So you cannot adjust it in any way. They'll also predetermine the annual increase. So all of these things, in essence, you are giving away control, right? Now, if you are aiming at resigning, the main feature, I'm guessing, the main feature or main reason that you are aiming at going this route is you want to be able to get yourself control, right? And let's go analyze that control from a deeper perspective. So when I refer to control, it could mean any of these elements or including all of these elements, right? Maybe you want to have control about the lump sum that you want to take, right? Perhaps you want to make that to be an appropriate amount. You don't want to take too much. You don't want to take too little, but you want to be in control of how much you take, right? Again, maybe you're looking at saving on tax. You also want to be in control of the income that you take. So maybe you don't want the income that GEPF provides. Maybe you need more, or perhaps you need less, or maybe you want the flexibility to adjust this on an ongoing basis, right? Where you are in control. Again, it's coming back to the word control. What about the annual increase of that income? Maybe you're looking for control over that, the ability to take control of that money so that you can determine the increase that you want to take every single year. You could also want control over your legacy, right? So you've accumulated all this money. You know, in the event of you opting to retire, what would take place? The income's basically guaranteed over a 5-year period. Touch wood, if anything happens to you and you don't have a spouse, that capital could be lost. On the flip side, if you are aiming at resigning, maybe now you're looking to take control of this because you want to create a legacy. You want this to pass on to a spouse. You want this to pass on to your kids and perhaps even your grandkids. So you want to build what I call generational wealth. So notice what I've shared with you here. It's all about taking control, right? Even from an investment perspective. See, maybe you're not happy with how GEPF is investing. You want to have control over investing your own money. So you want to make your own decisions on that perspective. Maybe also from a tax perspective. You want to have control over how much of tax you pay or how little tax you pay. You see, it can be restricting on the retiring side because those elements are fixed. You cannot adjust it. But on resignation, I'm assuming if you're watching this video and you're looking for that your main focus here is on control. So we're going to be starting to analyze that control and what are the elements that you need to put in place in order to effectively make use of the control, right? Now let's start to have a look at the flow of money. And then as I go through this, I'm going to be talking to you about certain mistakes that I've identified from members, things that I want you to avoid, right, when you're doing your planning. So you know that you have funds that are sitting here within GEPF. There really are only 2 options available for you if you are aiming at resigning. Just 2 options, right? The first route is you could say, and this is option 1, you could opt to take everything out in cash, right? So you're withdrawing all of this in cash. I know the alarm bells, I'm even writing it in advance. Going through your mind, right, is tax, right? Should you take all of this in cash, it's getting paid into your bank account, there's a huge amount of tax that's going to get paid. It can be frightening, and the concern is you could run out of money, right? Now, the rest of the elements, as I'm sharing with you in terms of resignation, it's all designed to look at that feature, right? So one, you want to have control of your money. But the second thing is you want to make sure that you never run out. And in order to ensure that you never run out of money, the way that I teach this is you want to start to look at what could come in the way that makes you run out of money, right? So what could happen that could result in you running out of money? If you paid too much in tax, you could run out of money. If you happen to invest incorrectly, you could run out of money. If you happen to take the wrong income, you could run out of money. You could also run out of money from a medical aid perspective, right? If you choose the wrong medical aid or it's not covering you, there's so many different elements that could take place that could result in you running out of money. So what I'm sharing with you in this video is how do we avoid that? What are the things that you can put in place to prevent that from happening? So naturally, this is one risk element. And in order to save the tax, it's actually simple, right? And you don't really need a financial advisor to give you this. So it's sort of common knowledge, especially if you've been watching the YouTube videos that I've created. You could move your money into an approved fund. Now, when you do that, when you move to an approved fund, the tax is equal to zero, right? The way that I want you to understand this is whatever gets paid into your bank account, it's going to be taxed. Whatever moves to an insurance company bank account is not going to be taxed. So if you are aiming at resigning and you're taking this out in cash, it's getting paid to your bank account. So this is why tax is coming in. You can avoid all that tax by transferring all of your money through to an approved fund, right? So if you're going here. Now I want to talk to you about some of the mistakes that members are making with the approved fund, right? Firstly, a preservation fund is just one option of an approved fund. What you want to do is look at what are the options available of approved fund. So you want to look at the different options. You want to compare them against your specific circumstances, right? So please don't compare your situation with another member because everyone's unique. It doesn't mean that they've gone into a preservation fund you need to go into. The correct way to do this is you want to analyze your options in advance, compare them to see which is the right decision for you to make before you sign anything, before you make a commitment here, right? So the mistakes members are making is they're going into the wrong approved fund. And that already is making a mistake right in the beginning of this, right? You also want to look at where this money is invested, because I've seen in the past where members make a mistake investing in the wrong place, and again, they run the risk of losing money, right? Which again creates a multiple number of issues because it's right at the start of resignation and you're already losing money. So you want to get this first step done correctly. You want to avoid those mistakes. Now, next step from there, you cannot stay in the approved fund, right? I'm going to say this again because I want you to get it well, right? The approved fund doesn't pay an income. So you can't stay in the approved fund. You've got to come away. The reason we go into an approved fund is GEPF says that this is the process, right? You must move into an approved fund, and then from there you can move up. When you're moving into an approved fund, you're basically relieving yourself of GEPF, right? You're coming away from most of the rules of GEPF and coming into the general rules that would apply to everyone else, right? When I say everyone else, I mean non-GEPF members, right? So in this aspect, this is where you can take your 1/3 amount in cash, right? Now, what are some of the mistakes that I see happening here? The mistakes you want to avoid here is I've noticed some members opt to take, because this is flexible. So please remember, this is a flexible amount. I'm going to put this in green, right? It is up to, okay? So up to. So first thing that I want you to know, first mistake you must avoid, right, is know that this is flexible. You don't have to take a full 1/3 amount, right? It's unlike what I mentioned to you earlier with retiring, where you have to take the gratuity. Here, you can adjust this. It's up to 1/3. So you can choose the correct amount. So that's the first mistake I want you to avoid. Know that it's flexible. It's not a fixed thing. The second mistake that I want you to avoid when you're going with this is in terms of the tax-free amount, right? So I've noticed a lot of members aiming to take the tax-free amount. I'm quickly heading over onto a tax guide to show you this. Please remember, when you're doing your tax calculation, you want to use the latest tax guide. I'm using the one that was the most current at the time of me shooting this video. So this is the 2023 tax guide. And you can see here, it refers to this tax table, right? Where it talks about retirement fund lump sum benefits and severance benefits. And it says that the first 550,000, there's 0% tax here. Now, what I've seen is members opt to take the 550,000 tax-free. Now, why I say this is a mistake is you could be missing out on certain hidden tax opportunities, right? That present itself. I know it's weird because it's zero tax here, but there's still other things behind this that could make this situation a lot better for you. So when you are withdrawing an amount, you want to make sure that you are taking into account the pre-98, right? So here's one of the other mistakes members are making. They're not factoring properly on the pre-98. Now, this is an issue because nobody can determine this right to the last cent, right? Which means it leaves a bit of a question mark. If you take too little, you're leaving behind money that would eventually be taxed. If you take too much, then you could put yourself in a position where you're having to pay tax, right? So you want to make sure that you're getting this thing done accurately so that, again, you're choosing the most appropriate 1/3 amount. Now, some other issues that I've noticed with members on the 1/3 value, in instances where members are taking the full amount, they're either taking that into a business. The problem or the mistakes around a business is if you don't have any knowledge of running a business, then it could be extremely dangerous, right? You run the risk of losing all of this money, which creates a ripple effect for you, right? Sometimes members are looking into some kind of property. When they get into property, it's to get a rental income. If you do this, it's okay, but I need you to know that rental income is another income. And that income is going to be a taxable income, meaning you must declare it. And when you declare it, this is where it can inflate your tax, right? So you want to be mindful of that. In addition to that, you want to be mindful that the property could attract capital gains tax, right? So in the event of you passing away, it's automatic. SARS triggers this thing that you had sold the property and it gets into the CGT, or even if you sell it in advance. Another mistake that members are making is they put a big chunk of this into a bank account, into fixed deposits. Now, all of these things, remember, are different for each member's situation. So I'm giving you a general overview. Your situation will be different, but I'm sharing with you what are the things members are doing and what are the aspects you want to avoid, right? When you're putting money into a bank fixed deposit, yes, you are earning interest, but you want to be mindful that that interest is taxable, meaning it's added to the income that you're going to be receiving, and that could push you up a tax bracket. So you want to be mindful of that. In addition to that, property, a business, a bank account, it does not have beneficiaries, right? Which means you have to be mindful of executive fees. So you want to think about this because that's an extra cost. You also want to be mindful about estate duty. And estate duty is a tax that we pay when a member passes, when we all pass away, right? So you want to be mindful again of these mistakes to try and avoid having to make that. This is on the 1/3 element, right? The next element to focus on here is on your 2/3. Now, the 2/3 side, the mistake that I see happening is when members are reaching out for guidance, they're not getting proper guidance in terms of what the options are. So on your 2/3, there are 5 different ways in which you can earn an income, right? I'll list them over here. 1, 2, 3, 4, 5. What are the mistakes that are happening? Is sometimes members are not being given the full 5 options from a financial advisor or planner. Let's just say you are given 3 options, right? Which means in your mind, you're only going to work with those 3 options. You won't know that there's an option 4 and an option 5. And because of that, it could lead to you making a mistake because what if those 3 options are not the best? You see, I've had some instances where members are just given 1 option. That's it. There's no other options that they have to choose from. The problem is once you make a decision here, it's pretty much cast in stone. So you can't really go back and adjust it. Even if you could, right? I want you to think about the tax consequences. I want you to think about how much you could have lost in that process, right? Because just one of the 5 options allow you to go back and make an adjustment. The problem is a lot of pre-planning is not done. So if you are aiming at resigning, you want to get your planning done ahead of time. So let's just say you are leaving, I'll put it as X being now, and you are leaving in a year's time, right? You want to start your planning done early as possible so that you start to consider all these elements and you're making an informed decision, you see? You don't want to wait to get to this point before you start doing your planning because by then it's too late. There's so much to cover. So that's some of the mistakes that are happening in terms of the 2/3 element, right? Also, in terms of the 2/3 element, if you take too much of income, this is where you could put your capital under pressure. And again, the capital could reduce, right? So you want to be aware from a tax perspective, if you take too much, you could end up paying too much in tax, right? If you are investing this money, so let's go analyze that a bit more carefully. This is still on your 2/3. This is the 2/3. If you are going to invest it, you're investing that capital and you are drawing an income from here. You want to be mindful about where that money actually gets invested, right? So what's the return here? What are some of the mistakes? Again, when the planning is not done properly and thoroughly, this situation could happen, right? You taking an income, I'm just using figures to make the math look easy. You're taking an income of 30,000 a month, but the return itself is just 20,000. If this transpires, it means that you're taking out more than what's coming in. See, more is coming out than what's coming in. Where's the difference coming from? The difference is coming from the capital, you see, which means if this happens in your first year, in year one, the capital is reducing. In year two, chances are you're going to take a higher income, right? Because the water is going up, electricity is going up, the cost of living is going up. So you're taking a higher income, but the capital is lower, which means in year two, it's reducing. Same happens in year three. It could be reducing. Same for year four. And this is where that risk is of running out of money with resignation. So notice I've shared with you now on the 2/3 element, what are some of the issues that are taking place, right? In addition to that, I want you to be mindful that there's also a tax that takes place on death. So you want to ensure that you've protected yourself fully, not just tax on income, but also the tax on death, right? What happens to this money at that time that you're not around? How does it pass along to your family? What's going to happen from a tax perspective? Because if that planning is not done well, it's basically you feeding those funds over to SARS, you see, which I'm assuming you don't want to do, right? So all of these things is just relating back to control. Now, I promised you at the start of this video, I'm going to share with you a secret, which I'm going to reveal now, right? In order for you to gain control over this, right, I want you to think about the profession that you are in. I don't know that profession. And if I had to come into that profession, chances are I'm going to fail, right? Because it's brand new to me. But you've been in that profession for a long time. Maybe you're there for 20 years, 30 years, or your entire working career, which means you're the expert when it comes to that. So if I want to learn something from you, I could figure it out on my own. I could go and learn this on my own, or I could come to you to say, hey, look, can you help me with this because you know it already? The same in terms of your control. See, in terms of your control, the secret is, and this is the most important decision you are going to make, again, which you have complete control over, this is your choice of specialist. See, your choice of specialist or financial. This is the financial advisor or the financial planner, right? Which you get to choose. You get to choose. Now, it's tricky because you cannot see financial planning, right? You can't see financial advice. But ultimately, you're going to make a choice on who you want to use. What's some of the mistakes that members are making in terms of choosing a financial advisor? So I'll cover just 3 of them quickly. One is, could be thinking that all are the same, right? Meaning every single financial advisor is the same. The danger with this is general financial advisors are giving general information, right? Information on education plans, information on life cover policies, but some of that information is not what you need. And GEPF is a very specialized service, you see. What you're going through and the decisions that you have to make, it's very specialized. So if you are working with this perspective, thinking that everyone is the same, you're going to assume that whatever has to happen is going to happen, right? Meaning if one financial advisor is going to tell you, hey, look, the tax is 500,000, there's nothing that you can do, you're going to assume, hey, yes, that's it. It's always going to be this way, right? So you're going to end up paying the tax. Same from an investing perspective. If you happen to lose money in the markets, you're going to think, hey, there's no other way that this could be done, right? If you're assuming that everyone is the same, right? How do you counter this? Simple. You want to get to someone who's specializing in GEPF. Now, I learned this stuff, and in particular, right, GEPF resignations. See, someone with a track record. Right? So how do I know this? Simple. I've been working with GEPF members now for around 20 years. And the moment I decided to transition into focusing on members who are resigning exclusively, right? Meaning I don't do life covers, I don't do education plans or any of the other elements around financial planning. Because my focus is specifically on helping members who are resigning, I have no backup plan, right? Meaning I don't have another income source. I have to make members successful in their resignation. If I can't make you successful, you now are going to tell others that I'm not good, which then creates a challenge, you see? And I'm not trying to convince you that you've got to use me, but I'm sharing with you the importance of using a specialist, right? It's like this. If you happen to have a heart attack, who would you want to go to, right? You can choose between a GP or you can choose between a cardiologist. So the same thing, what you are aiming for here is a very specialized area of financial planning, right? And you get that choice, you see? You get to make that decision in terms of who you're using as a financial planner in advance. Now, still, this comes with a major trust issue, right? Which is the second point that I want to share with you, is trust. Now, the only way to overcome trust, right, is you want to start engaging more with the financial advisor. But ideally, the best way for me is you want to do a test, okay? You want to do a test. For example, let's say you have some kind of investment right now, or you're having a tax issue right now. You're not yet resigning, right? But if I'm able to show you how to grow your investment, if I'm able to show you that in advance, right, before you resign, if I'm able to show you how I can save you on tax, right? So what it means is I'm now establishing trust with you because I'm showing you things to help you put yourself in an even stronger position, right? I'm helping you to grow your wealth. When you have that experience, this is how the trust has been built. And I've seen this for members who've reached out to me 3 years, 5 years before resigning. It makes the process easy for them at the time of resigning because they understand me, you see. They trust the process. They know the things that I've done before. I'm giving them regular updates so that they keep they're fully abreast with what's happening with the changes that are taking place, especially with the investing side, right? So your way to overcome trust is you test on a small basis, right? What's the mistake I see happening is members who are aiming at resigning, they've got millions, right? So X millions that you have, taking all of that to a financial advisor or a planner who you've got no experience with, you see, no experience with. So now you put yourself at risk because you've got millions here that are at risk. Whereas you could change this, right? You could do a small investment, for example, 100,000. You could do 100,000 investment, and by working with 100,000 investment, it just puts you in a position where you're testing the financial advisor because now this is how you want to build trust. You see, it's how you want to build trust. Now, the next thing that I want to share with you is in terms of, it's a critical element. It's in terms of price versus value. Because let's face it, this is what it's going to come down to, right? In your mind, you might be assuming, hey, if I'm going to use a GP, I'm going to pay a certain price, but if I use a cardiologist, I'm going to pay a lot more, right? It makes sense. This is how it is, right? Because a cardiologist is a specialist. But in this particular profession, it actually works the other way around. And I'm explaining to you exactly why, right? From a pricing perspective, we have to bear in mind among financial advisors and financial planners, the profession is still not really a profession as such, right? It's still heavily based on commission. And because it's based on commission, there might be a tendency where someone wants to secure your business, especially if you are resigning after many years and you've got huge amounts of money, right? Millions of rands. So from a pricing perspective, somebody could reduce the price really low. Let's use an example and say, hey, they're going to reduce the price to 50,000. Now, the problem with this is you cannot see the financial planning. And if the proper guidance is not done in advance, right? If it's not done, if there's no tax planning done, if there's no investment planning done, if there's no legacy solutions, no medical aid done properly and extensively, you can't create savings, which means from a tax perspective, you could end up losing 500,000 here in tax. From an investment perspective, you could lose a huge portion. Now you work out 10% on a huge amount of capital. This could be hundreds of thousands here. In addition to that, right? You also have to factor the tax on death. So notice what's taking place, right? And also the burden that could happen to your family if this money is not cared for properly, right? So even though you can pass a legacy, but if it's not passed along the line properly. From a value perspective, If you want to get this thing done right, it requires a bit more planning, right? Which means you need more time for tax planning. You need more time to do the investment strategy, more time for death taxes, more time to ensure that your family is protected, right? So you want to get all of these things done in advance. If it's done in advance, here's the beauty, right? The tax saving is going to be through the roof, right? I've seen cases where you can save up to, and this is what you should aspire to get to, right? Up to 100% savings on tax. This is on resignation because it's flexible, right? From an investment perspective, you want to get to a point where you can grow the capital. So what I shared with you here was where it's wrong, right? But what if you could grow the capital? So what if you put yourself in a position where you're taking an income of, I'm using the same example, 30,000, but the return coming in is 40,000. See, if you get yourself to that position, what's suddenly happening is the capital starting to grow. And if it's growing like that in year 1, year 2, you can take more. Year 3, you can take more because the capital keeps growing. So you want to get all of those elements done in advance. And this is where the value has to come in, right? So that could come with a price tag. I'll use an example. Let's say this is 2 times or 3 times or 4 times or even 5 times. Now you want to start looking at the value. If you are paying a certain price for a specialist to give you value and you are in a position to save 500,000 in tax, can you see? The fees won't amount to that much. If your capital is protected, it's not going to amount to that much. So you want to make sure you're getting all of this done in advance. You want to, it's fine. You want to look at something that's affordable, but at the same time, you want to start looking at the value. If you are paying for any service, what are you getting in return for that? Are they able to deliver the value? This is how you want to judge this. So I know the video has been long because I wanted to give you as much information as possible in order for you to be in a position to understand what are the things that need to take place, right? You can see now that there's a lot of mistakes that members have made in the past. I've analyzed them carefully for you, and I've shown you all the things that you need to do in order to avoid them. I've also shared with you that you just need to make one choice, right? Your most critical decision in terms of being able to choose this, if you want to make resignation a success, is going to come down to a specialist, right? If you want to work with somebody general or someone who's specializing in GEPF resignation solutions. Now, if you still need assistance and you want to reach out to me on a one-on-one basis, I'll provide details inside of the description where you'll get access to an email. When you reach out, I'll tell you exactly what it is, the kind of profile of members that I assist. And if you're a good fit, we'll go into more details from there. Now, if you found the video helpful, please post below in the comments. Let me know what elements of this you found helpful, right? How has this been for you? What are some of the elements that you find missing? So post below so that I'm able to see that for you. And I also want to encourage you, I feel as GEPF members, we've got to create a community. So share this among other members, right? Because the more people are able to make more informed decisions, the better it is going to be for every single member. Good. And I look forward to seeing you in the next video.